Uh, so welcome to our foundation's presentation. If you're new to Factum Financial, I want to let you know we are a nationwide agency specialized on teaching, educating, and helping folks implement in their families, in their business as an individual, the proper use of whole life insurance and life insurance strategies. We teach and are specialists in the infinite banking concept, and we love to educate folks about their financial management. We have education for years to build relationship. We're a relationship-based organization, and we serve clients from Florida all the way to Alaska, across the country, in this manner. So if you're here, likely you want to know who we are and you want to understand a little bit of our education, which you're about to see in this presentation today. The most important idea I can share with you for you to understand the type of organization this is in front of you. We call this the 5 areas of life. And it is a premise that drives the culture of our company, the way we build relationships with our clients, which is that we believe fundamentally there's 5 key areas in your life that are determined by relationships. Abundance in those relationships is going to allow you to express the potential in your life. We believe that your relationship spiritually, personally, with your family, with your money, and in your occupation or the community you serve should be relationships that you live to the fullest in abundance. And the reason we focus on educating you about your relationship with money is because in our belief, this is what's going to allow you to fund that abundance in those other relationships, to give, to receive, to share as much as you want with your family, with yourself, with your spiritual community, and in your occupation. So this idea is fundamental to us. If you want to know more about it, we have a whole curriculum and a set of activities we walk with clients to help them visualize what that abundance can look like. So I encourage you to please reach out to the agent that invited you to this conversation. Okay, to move the conversation along, I want to present to you the agenda that we're going to be covering today. We're going to be talking about 3 fundamental ideas. Please keep in mind over 45 minutes to an hour, we only can go to a high level of these ideas. There's a lot more depth to it, and we have 30 hours of content, 14 courses available to you. So if you are seeking more education, you've come to the right place in the right community. But we are going to start to talk about these 3 things to give you a proper orientation of why we have this education, why we talk about life insurance, how to position it, and if it may be right for you and what you're trying to accomplish. So you will leave with a lot of clarity out of this conversation today. We have 3 ideas. Idea number 1, we need to label what the problem we're trying to solve is. And you are going to be able to decide, yes, I'm experiencing this problem, or no, and these people cannot help me. Either outcome is wonderful. We want you to achieve clarity. Idea number 2 is that you understand how to position one of the toughest assets in the history and the economy of the United States, which is whole life insurance, permanent insurance. Why do we talk about this when we talk about financial management, when we talk about preservation of capital, control, the infinite banking concept? And the idea number 3 is the reassuring lie and the inconvenient truth. Nobody is coming to save us, and we need to use leadership and responsibility and self-reliance to start learning and implementing these ideas for us to be the directors of the movies in our lives. The relationship with money is for us to control. So this will be the agenda for today. And I'm going to go ahead and jump in the meat of the conversation for idea number 1, which is the problem. By the way, in the call, we have a lot of members in our team. Mr. Wade Borth is our Chief Insurance Officer, which I'd love to share some of these ideas with you and hear your comments here, Wade. But you'll notice that we operate as a team. We believe 1 + 1 = 11, so we want to serve you with the best ideas available. So Wade, if you see me sharing something, please chime in if you have any ideas to enhance what we're talking about, or if you think I'm crazy, I will not be offended, my friend. Okay. The book in your screen, hopefully everyone in this call has heard of, read, or at least looks familiar based on the fact that somebody invited you to this call. This is a seminal work by Mr. Nelson Nash describing the infinite banking concept. The book is called Becoming Your Own Banker. I'm going to point you to something I love to say to everyone that I come across. The title has the word banker in red capitalized. To me, the active word in that title is becoming. And that's what we're going to talk about today. How can we become capable of solving the following problem? The problem described in his book, by the way, is this. You finance everything in life. He says you either borrow money and pay interest, which all of us are familiar with because we all know about credit cards and loans and mortgages. The second part of this says, or you can pay cash and you can give up the opportunity to earn interest. It's a more difficult proposition. We're going to explore that here in a second. At the end of the day, the premise is we're financing things through others organizations, through other banking organizations. Call it Chase, call it private credit, not us in the proper seat of being the bankers in our life to supply the need for liquidity. Okay. This idea is initially difficult to understand. It took me probably years of exploring this to truly emotionally understand what this is. It's easy to intellectually get it, but emotionally is a very deep concept. And I wanted to bring you a quick example to show you this. The idea of borrowing money and paying interest on loan money, very easy. The idea of giving up interest on cash and opportunity cost is a deeper idea. So to illustrate that point, I took the liberty of pulling one of our calculators. If you see some of our content, you'll notice here that we have a lot of visual education, a lot of math, and we want to make sure that we help you learn the way you learn best. In this calculator, I had a quick premise for you, and if anyone wants to type in the chat, I would love to hear your thoughts. But when I ask someone, hey, if you're going to buy a vehicle with $30,000, or you're putting down payment on a condo, or you're going to pay for a $30,000 vacation or wedding, whatever the expense is, right? What's the opportunity cost? Most people don't have the way to visualize this. They don't know how to do that calculation. You need a future value calculation to do this, which is a financial calculator to understand how money could have grown. And I tell people, hey, if you take that $30,000 instead of making that car purchase, for example, and you let it grow at 4% for 30 years, how much money would you have at the end of 30 years? Guess what the answer I get most of the time is? And if you don't mind putting it in the chat, what do you think the math would be? $30,000 or 4% for 30 years. I can tell you, it is a very difficult thing to do in our heads. We don't think exponentially. It's very difficult to think about compounding money over time. I don't see any comments on the chat. So I'm going to give you the answer with the spot. 45 grand, says Ken. Thank you. $97,000. One financial decision. If I ask people, how much would it cost you to spend that $30,000? Most people would say $30,000. But there's an opportunity cost because we could have earned interest on that money if we kept the money. So we're constantly dealing with this problem. Either I pay interest if I use somebody's savings, or if I use my savings, I give up the opportunity to earn interest. If you don't think you're dealing with this problem, I have to tell you, likely you've been dealing with this problem since you were born, and you're likely going to deal with this problem moving forward for the rest of your life. You were going to say something there, Wade.
No, I think it's hard for people to visualize this because, nobody sits down and writes a check after that 3-year period for $67,000, or they don't write a check along the way, where they can see the cost of putting money, borrowing money from Chase or from Wells Fargo, because they see that amortization, they see what that interest cost is, and they get that part. The part that's hard to get with this idea of opportunity cost or just lost ability to buy something in the future is the fact that nobody sits down and writes a check for $67,000, but it's a true number over that time frame.
Correct. It is very different. We think linearly, 1 + 1 + 1 + 2, right? But when you have to do this type of calculation, it's very difficult. Let's be honest. Also, we've never been taught or conditioned to think this way. It's a new paradigm. So let's explore the same idea in a different fashion. If you are maybe in the real estate space, you're a real estate investor, or you've bought real estate in the past, you likely have seen this face before. This is Mr. Robert Kiyosaki, very famous for the Rich Dad Poor Dad book. A follow-up to that book in his series is called the Cash Flow Quadrant. And he proposes a model that I think is really appropriate right here to understand how we fit into this economic world in the United States. He says that there's basically 4 key players in the economy that play very different roles. There's an employee who has a job, a self-employed who owns a job. A lot of us have been there. A business owner, who's the person now that owns a system and people work for them. And finally, an investor, person that money works for them. And when we're trying to understand where we live in this world, Robert's book's premise is that moving to the right side of this quadrant is very effective and very beneficial for us because there's a different tax treatment for these people and because the presence of leverage through money or through others. And we all likely would agree business owners and investors in our economy tend to make more money or tend to be wealthier individuals than employee and self-employed in general cases. Of course, there's exceptions. The question I would have for all of you, going back to the idea of the problem, is where is the banker, the person sitting there controlling, moving money between these parties? Where do they belong in this model? And the premise that I want to pose to you is that it's interesting to think that the employee needs a place to deposit their paycheck, and the self-employed person needs a bank to move money from transactions that they charge. And the business owner needs a bank to make his payroll payments, and the investor needs to make transactions to acquire assets. And the reality is that the banker is embedded in every single one of these activities. Wait, it's fascinating to think about it. If I shift this and I actually make it a different visual for you to see what I'm saying here, what I'm suggesting is the following. Banking as a function, as an activity, not the building in the corner of the city, right? As an activity, is an activity that is ever present for all these folks when they need to store money in an entity, when they need to access money and borrow or access money, access liquidity from a bank. And the banker is happy to sit at the middle. They will take the deposits from all these four individuals. They would likely lend the money to the same individuals as the controller of the function. When they do that, the expectation is that the borrower will pay a certain amount of interest that's high, and then they will pay a lower amount of interest to the depositors for the pleasure of storing their money away. This is, in a very simplistic way, and I realize that, an interesting way to think about how the banks are a major force in the economy because they sit at the center and they control the movement of money towards them and out, and they make business about being very efficient of this. The banking function I would describe as a function of control. And a question I would have for any of you in the call to start to prime your brains here, like, why have you never considered being at the center of this chart? We all have played the saver, the borrower roles, but I would argue that playing the role of the banker is a very effective way to live in a closed economy where I control the flow of money in all positions. Any thoughts in their way?
Yeah, I would probably add to that comment, like I hear this all the time. How can this be true, or how is this even possible? And I've never heard of this before. And I think the important part is like, who's here to teach you that? Do you think the bank is going to give you that information? Do you think the people that are controlling the flow of money? I mean, think about how powerful this model is that you're looking at on the screen right now. Money's going to flow into the bank, and the bank doesn't lend their own money out. They lend the person that put the money there. And so
Mhm.
all they're doing is transacting dollar bills. Now,
Yeah.
granted, they got some overhead and stuff like that, but they're transacting dollar bills. It is one of the greatest businesses in industries in the world that if people could just get their arms around this, it would be crazy. And we don't have to go and do, we don't need a charter. We don't have to go and deposit, 10 million dollars into an account to make this thing happen. This can be done at the you and me level, and that's what we're going to talk about tonight.
Yes. If you don't believe what Wade and I are saying, walk in any of your local branches in a bank and go look at the marketing material they have in the lobby. And it will be targeting savers that need products to deposit their money, and it will be targeting borrowers that need liquidity and need loans and credit. None of those marketing materials, none of those dollars are spent to teach us control the banking function, which should be a big ding, 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 ding bell going off on your heads at this point. Okay. Let's make this real for everyone here. So another way to think about permanent control, and going back to my statement, this is likely a problem that has been present in your life, and it's a problem that likely, if you don't do anything about, will continue to exist because it's ever present. It's the opportunity cost. Let's do a quick mental experiment. Let me ask you a question, and I like to ask for you to ask yourself the following. If you were to add all the money you've earned in the last 10 years, I'm going to keep it simple. If you earn $100,000 a year for the last 10 years, $1 million have moved through your hands in income. Okay. The question I would like you to ask is, once you understand how much money that is in the last 10 years, how much could you access and write a check for today if the deal of a lifetime came across your desk? What's the biggest amount of money you would have access and control over that you could write a check today from all the money you've earned in the last 10 years? I'm not going to ask you to type that in the chat. But the way I would ask you to consider this is if you've had $1 million and you can only write a check for $50,000 today to buy the best deal you've ever seen, that's a 5% control of everything you've earned. The answer across the country, and we teach this in all kinds of communities from Florida to Alaska, like I said, is typically 5%. 5% of everything that I've earned in the last 10 years is under my control. A lot of times it's less. And this is a testament to the fact that somebody else, a third-party banking institution, organization, is controlling the flow of money in our life. And it is taking away the control we should have over the dollars that flow through our hands because we are the ones sweating and putting the work to earn that money. I think it's a right we all have personally. We just need to have the right education and the right implementation by accessing the right guidance, which is why you're here on this call today. Now, let's do one more thing to visualize this, Wade, and I think this is important. And by the way, we are very intentional about spending a lot of this presentation talking about the problem, because if once you know what's going on, you'll know exactly what to do. This is something that comes directly from Nelson. Understanding the problem is a key part of then later being able to say, this is the right guidance that I need, and I need to identify the process and the solution that I'm going to implement to solve this. So I'm going to put it in terms of this. If I was to simplify how Americans spend money, okay, I will give you a little simple chart like this. 20% in autos, around 30% in housing, 45% on living, and Americans will keep around 5% of everything they earn. Okay, that's the annual pattern of spending of most Americans. And typical financial planning will give you an advice that sounds something like this. Hey, you're going to take that 5% that you're saving and you're putting in a vehicle that gives you as much rate of return as possible so you can grow that money over time and eventually you can retire. There's some risk associated to it, but we're going to try to crank that money with the most rate of return possible, and we're just going to move forward that way. No one, and it will be the exception for our team because it's a different type of advice. No one is really saying, hey, what if we look in that 95% that is going out the door? You're earning it and going out the door, earning and going out the door. What if we found some efficiencies in that money? Maybe I'm overpaying in insurances. Maybe I'm overpaying in interest. Maybe I'm overpaying to the IRS in taxes. Maybe my investments have fees, right? Nobody's saying, what if we took a larger chunk of that 95, move it to our savings, and now that we have more money, perhaps we can find a more reasonable rate of return to accumulate wealth over time. It's a different type of process, and banking is less about rates of return and more about control of the money. So I'm going to take autos just because it's universal for all of us living in the United States. Likely in most cities, we all need a vehicle to move. So if I take autos, and I were to do an experiment here on the call, and I said, hey, we're going to talk to the savers, we're going to talk to the borrowers. These, by the way, are the two ways in which 95% of Americans likely purchase a vehicle, through cash or through an auto loan, right? And if I started asking you about benefits of either, well, with cash, I don't have payments in the future, and the car is mine, and I don't want to pay interest to an institution. And the borrower would say, well, I don't have to use my own money. I take a loan, I just make monthly payments, I don't mind, and I don't care about the interest. I just don't want to use my own capital. Great. What about the costs? What about the cons of this? Well, when I pay the cash, yes, I give up the cash. I don't have it, and that could have been a rainy fund or liquidity that I have access to. And the borrower may say, well, I am paying some interest, and a lot of times it's more than I want to pay interest, right? So they'll have a conversation, and not that they're right or wrong. A lot of those statements are truthful, but the question that we should be asking needs to be elevated to the following. After all your auto purchases, and think about all the cars you've bought in your lifetime, right? How much money do you still control from all the cars you've bought in your life? If you have 9 cars, if you've owned 9 cars, right? Think about car number 1, number 2, number 3. Do you still have the car? Likely you don't. How much money do you have from those car purchases? And the answer that all of you will likely give me is 0. 0. Because the money is transferred away. If you want a visual of what that looks like, think of this. The borrower has no time to waste. They cannot wait. They're going to draw a loan, and they're going to pay that loan over time with principal and interest from future income. The saver may say, I'm going to have some patience. I'm going to accumulate this money. And when I have the amount of money, I'm going to buy it cash. And they both will do this over and over and over a lifetime, thinking that the other one is wrong, by the way, arguing that the other person is wrong, without recognizing that both of them will end up in the same outcome. They control $0 of those purchases, which is the banking conversation. No permanent control of the money they're spending either through credit or cash. The problem that Nelson talks about in his book.
You did it?
Yes, sir.
I would add a little bit to that one too. It's like, which one, if you're dealing with Chase or Wells Fargo, which one does the bank appreciate the more? Which one do they love the most out of those two?
Any comments on the chat? Who does Mr. Jamie Dimon love more, savers or borrowers?
Anybody?
And feel free. We will not judge you if you have the wrong answer. Just kidding.
We'll make fun of you and no.
Yes.
So
we got a couple of borrowers.
Yeah.
Okay.
Love it. Thank you for participation. I would say they love both equally. Why is that, David? Why do they love the saver as well as the borrower? Because at the end of the day, all that money flows back to one institution, to them.
Yes.
They need one to make the other. And so they're in control. And that's probably the crux of that whole conversation is that when the money flows away from you and flows back to an institution, they need those savers so they can borrow the money to the guy that can't save. And so they love them both equally because they're the ones in control.
Yeah. So this is the problem that we're trying to address. This is the problem actually that we address for our clients is ever present. It's been here and likely will be here if you don't do something about it. And hopefully in your heads, what you're asking yourself now is, okay, what are you saying, David? Like if it's not one or the other, what's the alternative? And I just want to give you a summary of how we think about this. If we continue to use autos, the average American will own 13 vehicles in their lifetime. At current pricing history, they will spend around $400,000 in vehicles alone in their lifetime and end up with $0. Lack of control of money. And what we're suggesting is that you could have the same spending pattern, $400,000, but if you change the way you finance those vehicles by understanding how to control money in the right savings environments with the right process and the proper guidance, you will be able to take advantage of capturing that opportunity cost and end up with $1.5 million. I'm not going to get into the math of this today. So if you want to understand how we get to that $1.5 million, I'm going to ask you to reach out to the agent that invited you to this call and request the Infinite Banking and Auto Purchase video that we have in our educational courses, because you will want to understand how people buying the same number of cars over a lifetime will end up with $0 or $1.5 million, which is $1 million opportunity cost over your lifetime. Okay. This wealth creator is the idea that we can take that saver and borrow behavior and allow our money to grow and compound at the same time we use a savings environment that gives us access to liquidity to finance everything in life. That's how we address the problem we're talking about. Now, we've talked about the problem quite a bit, and I hope that at least this sparks your curiosity and you want to learn more and you want to understand more, particularly how it's relevant for you. Maybe not autos, but I promise you this is ever present in how you're financing your major large purchases like vacations, like vehicles, like prime residence. It is affecting how you interact with your investments. If you don't have this clear, I invite you again to reach out to the person that invited you to this call. Now, we're going to get into idea number 2. Wait, idea number 2 is the toughest asset. Why are we talking about this? We'll be always very direct. We're talking about properly designed, participating, dividend paying whole life insurance policy. So I want to put into perspective what this asset does, what it is, where it lives, why it's important, why all of us in the call that are part of the Factum team are obsessed in educating our community about it. Most people don't understand it. So if we go back to the argument of banks, Wade, let's say that they're very good at playing the best role in the economy, which is controlling money. We need to ask ourselves, where are they storing money? Okay, I call these guys the 4 amigos, the 4 largest commercial banks in the country, right? These guys have significant amounts of their most pristine amount of money, the cleanest, most secure, risk-free money 20 something billion, 19 billion, right? Significant amount of money on something called bank-owned life insurance. Okay. Most people would be surprised to learn that the largest buyers of life insurance in the United States are banks, commercial banks in particular. Okay. If you don't believe me, you need to go to the FDIC website and do some research. You will be astonished of what you find. And if you see that, and you don't understand it, let me give you the contrast that we see in our community for you to understand that perhaps this is intentional. The banks are not teaching you how to be the bankers. If you ask commonly the average person, the average American, hey, what do you think of what you've heard of life insurance? The statements they'll provide sound like this. Terrible rate of return, super low, it's expensive to own, and by the way, the worst investment of all time. If you want to truly understand life insurance, whether you agree with it or not, the first note that I want you to take is this. Whole life insurance and life insurance in general should not be an investment. It is not an investment. Please, please, please. The number one reason to confuse and to misclassify and to misunderstand this asset class is by comparing it to any other investment you have in your balance sheet. So please be clear, it is not an investment. I'm going to show you the contrasting image here. These are the benefits of whole life insurance. This is not Wade or David or Factum saying these are. This is how the banks themselves describe why they're the largest buyer of this asset class. They have things like guarantees at the center. They have constant growth and compounding in their money, access to liquidity on a guaranteed basis, loans, the ability to borrow against the equity in these contracts in incredible terms that you control, completely private, with great yield and monthly growth, in addition to the fact that they have a death benefit as they should as for being life insurance. If you are in this call, all you've thought about is life insurance is likely just death insurance, is death benefit, and I own some of it and I put it in a drawer and never look at it, I implore you, please wake up to the fact that you need to put that piece of paper, read it, and understand the benefits, the living benefits that give it the name life insurance. It is likely going to become a more meaningful and significant asset in your life the moment you understand it. Okay? So many, many benefits to this that people misunderstand. I'll tell you, it's going to address the number one problem we're talking about here, which is you finance everything in life, and it's going to allow you to take advantage of capturing the opportunity cost on your cash and liquidity. So in order to position life insurance, where should life insurance live? David, you said it's not an investment. I'm going to show you a quick model, a very simple graph. Hopefully, in addition to the fact that you learned tonight that life insurance is not an investment, this becomes the second idea that you engrave in your head. Even if we never see you again, it will be a great blessing to have a model to understand how money moves through your life. We call this the path of money. And the premise is very simple. When you work and you receive money, there's 4 things you can do with money and 4 things only. Please email us if you find a fifth. I don't think anyone has emailed us in several years, Wait, after we started teaching this, because there's only 4 things. So I'll show you. When you work for money, you create income, and that becomes cash flow in your income statement. If you've ever heard this fancy word, P&L, income statement, cash flow, all it is money coming in and going out. So when it becomes cash flow, you have the ability to spend some of that money. You're going to donate some of that money. We're a generous country. What's left, we call savings, okay? And savings is the only amount of money that ends up moving to your balance sheet, the box at the bottom where we hold and control assets we own, okay? And the 2 activities, the 2 options at the bottom is you're either going to hold that money in the foundation of your balance sheet as liquid cash reserves, or you're going to invest money to accelerate your wealth, hopefully so the money creates more money. We call that additional cash flow, and we continue to grow this activity over time. I will tell you, if you don't have a model for how money moves in your life, I can tell you, please take us up on this. Adopt this, request the training associated with this from your agent. This is a great diagnosis tool. If you're feeling financial pressure, I can tell you quickly, you're either out of proportion in any of these 4 activities or out of sequence. I'll leave it there for you. Now, if you're asking, okay, David, where the heck would you position life insurance here? It's an asset we own, so it should belong in our balance sheet, but it is not an investment, which means it is a foundational asset that lives in that green box, and it is used to hold our liquidity for the benefits I just shared. It is not an investment. I'm not going to stop saying that so you don't get confused about this. So if you're asking yourself, where does this live? Where should this live? It should be a foundational asset. Now, let me give you a little bit of mechanics. Now that you know where to position life insurance, let's talk about how we would use this and what the mechanics would be, because I think that's probably the reason you're on this call. You're trying to understand at a deeper level how many of us use this asset on a daily basis. Now, two options. We're going to talk about option one, option two, person A, person B, right? Option one describes again how 95% of the country deals with liquidity, with cash reserves, okay? Every person that is in this paradigm is behaving like a saver or a borrower. We'll talk about the savers first here. So they're going to save $50,000, okay? Every time they want to move money to either make a large purchase or, more exciting even, make an investment, okay? They have to draw money from where they're storing that money, likely a bank, to send it to the investment. The account will be empty until money comes back, hopefully with more dollars for it to be a profitable investment, and they replenish their cash, okay? Every time they create that interruption, as we established earlier on in idea one, there's an opportunity cost. We give up the opportunity to earn interest on our cash. Very costly, more than we think, by the way. And all we're suggesting is with idea two, with option two, is that instead of using the bank, a third-party bank, to hold our cash or liquidity and finance everything from there, you use a life insurance policy, a life insurance contract as the place where you actually hold liquidity, and the bank is only the party that helps you make transactions and move money around in the economy. The reason we do this is because now we have permanent control of our money, and we're adding these 8 benefits we initially talked about by establishing a relationship with a mutual insurance company. This is a big deal because at the end of the day is what actually unlocks our ability to behave like the wealth creator and compound money at the same time we have access to liquidity to finance the things we need, including investments. So the process here in a nutshell, in plain English, is this. We are not suggesting you change anything in your life that is associated with investments or large purchases, although we have great education on financial management. The conversation we're having right now is all we're suggesting is you add a tiny step and you move your liquidity from a third-party bank to a contract that you own and control in life insurance for you to enhance the benefits that your money is experiencing and give them the benefits that it deserves, and to be able to compound money without interruption. This unlocks your ability to create wealth. Okay? If you want to see this come to life, I'm going to show you an example. Mr. Kyle Fuller is not on the call. He's the CEO of our company, and he's graciously shared some of his experience in some of his policies. So I brought that to our conversation today for you to not just see it theoretically. This is real. This is Kyle's policy that he started 10, 12 years ago. And over time, the behavior of these assets in terms of storing capital allow us to have more and more access to money is phenomenal. There's a lot of numbers here, and I'm going to simplify this for you. All I want you to notice is at this time where Kyle is, year 12 to 13, right? In year 13, every time Kyle pays a premium, which you will see described here in the third column, says $8,000. The policy cash value, the equity inside the contract, will grow over time that year. In year 13, Kyle is expected to pay $8,000 and his policy will grow $13,000 or $1.63 per dollar of premium. I don't know, many of you have Wells Fargo or Chase accounts behaving like that. I know for sure I don't. Okay? Wonderful place to store. But the movie here is that this is an ever more efficient picture every single year. I'm going to roll back into the future, year 28 or 15 years later. Same amount of premium, but the growth increases. $3.10 for every dollar of premium he's paying. And that equation never stops. But another 15 years, year 43, age almost 70 for Kyle, he goes down to a minimum premium, $2,600. By the way, there's a range of premiums, and if you want a whole education on how to structure this, you're talking to the right team, by the way. But even with the minimum premium, he will get $13.50 for every dollar of premium he pays that year. This will happen whether interest rates go up and down, inflation goes up and down, taxation goes up and down. private contract that allows him to enhance the benefits and the benefits that his cash reserves experience. Very effective way, right? You look at this and you may still be asking, so what, David? Well, let me tell you. It is not just about the ability to store liquidity with more benefits, but it is the ability to access that liquidity to do things in the economy to enhance your financial life. Kyle, at 30 years old, lives in Phoenix with his wife and his family, his two boys, and they have the ability to buy a home in the middle of 2020, the pandemic, for $335,000, single family residence, right? Kyle has been storing for several years, $60,000 in this contract, and he can go and say, Mr. and Mrs. Insurance Company, I'd like to access $17,000 for a down payment so I can own and control this new asset. And instead of taking $17,000 out of his bank and interrupting the growth of that money, what Kyle will do is actually borrow against the equity he has in his contract from the insurance company, which is going to give him a loan, typically around 5%. Okay. He will access that liquidity so he can buy the house and he can continue to grow the full $60,000 day after day after day and have access to both. This is wealth building at its core. Kyle had the opportunity to sell this house with a net profit of $200,000 because of appreciation and because of the fact that he has some tax strategies that he could apply to make this a very profitable decision. When that money comes back, he has the opportunity to repay that $17,000 loan and remove the lien against his cash values. And then the additional cash flow he created in that activity goes where? Exactly right back into his savings environment to make that 60,000 a much more significant and larger number. Permanent control of money and the ability to access liquidity without interrupting our cash is what allows us to continue to grow and grow and grow our balance sheet and our financial picture. If you want to know the effect of this, I'll give you a quick summary just to summarize the whole reason of why we're bringing this example to you. Option 1 and option 2. Kyle had the ability to purchase this asset. He could have gone to the bank and pulled $17,000. The opportunity cost of that money, because he was not going to earn any interest, would have been $179,000 over 60 years. Okay, very difficult number to calculate. More importantly, once he sold the home, he would have had this profit. And if he was very, very sophisticated, he would have maybe bought some treasuries and held them for 60 years, which is very unlikely. And he would have earned maybe close to $935,000. That's option 1. This would be best case scenario for most Americans that do most of their transactions with cash in this way. What did Kyle do? Kyle instead used $17,000 of a policy loan against his cash value. Okay. The money continued to earn 4%, which earned him, it is continuing to earn him this interest. He's capturing that opportunity cost, $179,000 by age 90 for one financial decision. By the way, there's a cost to this, the 5%. He borrowed the money for a few years, so it cost him around $2,000 to be fair, absolutely. But then when the $200,000 come and he continues to earn that 4% net of taxes and fees, the interest he earns is $2.1 million. Gentlemen, ladies, I'm bringing this example to you to tell you the following. One financial decision had nothing to do, same house, same purchase, same sale, same profit, stored in the proper environment, controlling the banking function, using the toughest asset known to our economy, whole life insurance, created a $1.3 million increase in his wealth plan over the next 60 years with one financial decision. Now, ask yourself, for everything you're financing, from large purchases to your investments, vehicles, houses, debt, investments, real estate, what's the opportunity cost that is staying on the table by not using the right savings environments for your cash? Any thoughts on this, Wade?
No, I think people look at this and it says a lot of numbers, a lot of things going on. But at the end of the day, really what we're talking about is just what environment are we sourcing our debt from?
Yeah.
And who's in control of that?
Yes.
And so when we look at that, I think really the bottom line is like I'm making more by running it through my policy. Now, what makes it work is the fact that he started, he got it going, he had access to it when he had the opportunity to buy that house. So,
Mhm.
getting started is like one of the most important things. And then he found out how great it works, and then that's when the ball really starts to roll. But it's the idea of taking, that awareness that there's got to be a better way. And when we look around, I've heard Kyle say this too, is like wealth leaves clues, right? There's clues all over the place. Wealthy people are doing this, banks are doing this, so why can't we be doing this? That was the
Uh,
first thing. And then he took advantage of that. He implemented it and is like, now I see what the wealthy think and what the wealthy are doing. And again, wealthy, they don't have a magic wand. They just act a little bit differently than most people do.
I'm going to take it to an extreme, Wade. I don't think it's a little different. I think it's the complete opposite to what most of us, unfortunately, are doing if we're not properly educated. It's a significant difference because they're thinking about a radical control, permanent control of money. It's the premise in Rich Dad Poor Dad. The wealthy do the complete opposite to what the poor do. So I agree 100% with you. By the way, if you're stressed, we're going to fast a lot of numbers. Please remember this call is being recorded. You'll get the recording. We also have a set of, educational videos that support every piece of this, the math on vehicles, every single conversation around the path of money, the examples we have, real estate and anything you can imagine under the sun on how to use the policies. By the way, Daniel has a question here. Thank you for being here, Daniel, by the way, first of all. He says, can this be used on a house in a house that one already owns with a loan on it? And Daniel, the fact that this is a private contract and that you are in full control and ownership of this asset actually implies that you don't have limitations on how you can use these policies. As a matter of fact, when you request a policy loan, the two questions you'll be asked is how much you want and where do you want to deposit it, up to 100% of the equity you own in this contract. So in your scenario, and obviously would ask you many more questions to be able to help you, which I recommend you have a conversation with your agent, would be absolutely. The question would be is in which way would you use it? Do you want to use it for a down payment? Do you want to restructure the debt you have in that home? And the answer likely would be yes. How you go about it and how you do it definitely needs to be an in-depth conversation. But to give you a perfect example, the studio I'm sitting on is in my home, and the down payment on this home that I'm sitting on today was financed through a policy loan from my portfolio policy. So absolutely something you can do. Okay, I'm gonna actually use your question to make it more broadly. So you may be asking yourself, okay, guys, we talked about the problem, but what are the issues that you are actually solving for people, and who are you serving? Let me give you some insight into this. So if you're somebody in this call that deals with unpredictable income, okay, maybe you have volatile income like us in the call. You earn commissions, you're a real estate professional, you're an insurance professional, you're in sales. The ability to store enough liquidity to deal with the volatility of income is really powerful. So please consider that this may be a solution for you in your business and in your practice. If you're dealing with issues in your family or your business when there's excessive spending, that excessive spending is more expensive than you likely recognize, and it's likely robbing you from controlling more money permanently. So if you want a process where your savings strategy and your savings environments force you and become a magnet for you to put more money and have more control and have a more efficient way to finance some of these expenses, this may be for you. I highly encourage you to educate yourself. Third, if you have reliance on credit and you're the type of individual that we come across that says, hey guys, all my money after expenses goes to investments. And if I need any liquidity, I go borrow against a HELOC, against one of my properties, or I would use a line of credit or borrow against my stocks. Or if you have reliance on credit and you have not considered that perhaps some of those lines of credit could go away when events come in the future and you need a more permanent, solid solution for your liquidity needs, I can assure you this asset can be really powerful in your life. Number four, wait, this is probably the most common thing we help individuals solve. It doesn't matter if you make $60,000 a year or $6 million a year. We see this across the board in the country. If your liquidity is not strong enough, and by strong enough, I mean when you go to bed, if you can put your head on the pillow and have no financial stress, you likely have enough liquidity. But if you continue to think of money, we would invite you to consider that your liquidity needs to increase. And the reason it hasn't increased before is because you don't have the proper savings environment to incentivize you to have more liquidity. So please think of that. And then finally, if you have retirement uncertainty, if you're concerned about volatility, if you're concerned about your strategy of accumulation and distribution, and you don't have a lot of visibility into how this money is eventually going to become your source of income, I can assure you there's ways in which this asset can be very valuable to you, and we can lay out a strategy to support you in your retirement to have more certainty. Now, you may be also asking, okay, who do you guys help? Am I too old? Am I too young? I make too much money, too little money? Do I qualify for this? Okay. I'm going to briefly give you insight into different folks that we support here. By the way, personally, I own insurance on myself, my wife, my kids who are 5 and 3, my dad who's 68 years old, across generations. If you think that perhaps you are in a group of people that do not qualify for this, I will just encourage you to educate yourself, because the benefits are a wonderful tool to maximize the potential of your money. In this page, you see here a 30-year-old client, a 3-year-old client, a 65-year-old client with very different needs, either savings and holding liquidity for future financial needs like my son, Oliver, or somebody at 65 that wants to make sure they have a legacy and protect some of the assets they're on. And you'll see here in these gray boxes a range of premium. Minimums, maximums. We need to have a conversation more in depth if you think this is something you want to explore. A total amount of cash value, the total equity they control, they can borrow against, the growth based on that equity on a monthly basis, net of taxes and fees. Ask yourself if you can have an account where you put $154,000 and have it grow $1,000 a month net of taxes. Very difficult to find a commercial bank that offers that. And if protection is important to you, there's a death benefit associated to it, which 100% of these contracts will deliver because it's permanent insurance. 100% of us have 100% probability of dying, which is a beautiful way to protect the people we love when we're no longer here, and to give us the permission to spend the assets we own when we are here. Okay. That's an example. And if you want to see another example, a 66-year-old, 36-year-old investors, 37-year-old business owners. And you'll see here the contrast is larger premiums, larger cash values, larger growth. This at the bottom here is an individual that owns a portfolio of policies, not just on himself and his family, but also on business partners, key employees. This asset is very versatile in protecting money and protecting the humans in our life through this death benefit and through the living benefits. So if you're considering, oh, am I too old? Am I too young? Please have a conversation with our team. You will be surprised how your perspective can shift when you truly understand what's going on with this asset. Okay. That in closing for this idea number 2, I want to give it a few minutes to questions in this idea number 3. These are the benefits. If you've never seen this, I highly encourage you to ask us more as a team. Tell me more about these benefits. Tell me how they work. Tell me how important they are. The last thought I wanted to leave you with is all those individuals you just saw there, and by the way, they're all real clients with policies that are 6 years or younger. These are not people that have been doing this for 20 years, by the way. So very effective growth. They all enjoy these benefits at the same time without creating any trade-offs. Whether they borrow money, whether their premiums are high or low, whether they're 66 or 3 years old, it doesn't matter. Ever-present benefits to enhance the quality and the opportunity in your cash reserves. So that concludes this idea number 2, the toughest asset. And I want to leave you with a quick pick on idea 3 and open up for questions. The reassuring lie and the inconvenient truth. I'm going to show you some data because I want you to consider this. We've talked about the problem, the fact that it's ever present. We talked about how we position this asset in our education and how we serve people in our company. Think about you now for a second, okay? I'm going to show you 3 things, 3 statistics across the country: income, savings, and liquidity. So if you are curious about these numbers, and I'm going to flash them quickly. If you're curious about how your income compares to other Americans, let me tell you the following. If in your household, on a gross basis before taxes, you make between $150,000 to $180,000, you make more money than 90% of households in America. That is 190 million households in the country, okay? We are incredibly blessed with the opportunity we have to make money in this country, okay? If you want to compare that to the rest of the world, $34,000 in income will make you earn more money than 8 billion people on this planet, 99% of humans. Most people think that to be in the 1%, we need to be Elon Musk's. And that is not true. We are very, very, very blessed. So if income is not the problem in our country, okay, for most of us in this call at least, what is the problem? Well, I'll tell you, most Americans unfortunately keep less than 5% of income. This is a chart that the Federal Reserve tracks for savings across all Americans, income minus taxes and expenses. Americans only keep 5%. Only when we got steamy checks after COVID, we went up and then it came right back down with inflation. This chart goes to the left and it's the same. And I promise you, 2025, 26, 27 will keep that trend because it is a behavioral issue. If you want uncommon results, I'm telling you one thing and one only. Please consider that out of your wonderful income, you should be keeping between 10 to 30% to do uncommon things with that money. This is what unlocks the ability to actually build wealth. And the third thing I'll put in front of you is this. How come most businesses, regardless of location and industry, only have in average in our country less than 30 days, 27 days of liquidity? 27 days of liquidity. We have incredible incomes and revenues, low savings rates, and low level of liquidity because when we save money in a third-party bank, we are not excited to save money because it doesn't have a lot of benefits. The banks are benefiting from it. So we need to change the environment. We need to understand that we need to hold the ducks in green. A foundational asset likely is going to be an asset like whole life insurance for you to maximize the benefit and incentivize you to build a larger and larger pool of liquidity. One closing thought for you is this. The reason to think about this idea of the reassuring light and the inconvenient truth is that nobody's coming and we need to educate ourselves not only about the things we've talked about, but our financial management, how money works in our life. The typical client, the typical American likely has a financial statement that looks like this: $150,000 in income, top 10% earning in the country, right? A balance sheet with $50,000 in liquidity, and the rest, $850,000 in net worth. Regardless of your numbers, I want you to think of the following. The person we encounter comes to us with the following question. Guys, I have a current net worth, 850, the number doesn't matter, 100,000, a million, 10 million, doesn't matter. And they want to know how to go from there to a target. I want to make my net worth, my assets grow to $3 million. And the question we ask them is, hey, what's your next move? What are you doing next? If you want a representation of what this feels like for most Americans, it looks like this. This is what it feels like. A mumbo jumbo of many options to do and to execute that is very overwhelming. This is pushing most Americans to go to typical financial planning. I need a financial planner that can deal with this mess and tell me what to do because I don't even want to think about it. And we give up control. And all I'm suggesting to you today is you came to this class because you want the proper guidance and the proper models to think with more confidence and to behave like a person that's leading your family, your business. All that mumbo jumbo can be organized perfectly for where you are so you can choose the most relevant move next, things that apply to you. You take care of the foundations and you don't get distracted with shiny objects in the future. If you want to know more about this, our team would be delighted to help you understand where you are, where you're trying to go, and how to build a bridge with the proper action. With that, my friends, we've talked about 3 ideas: the problem, the toughest asset, and the reassuring light and the inconvenient truth. I want to thank you all for being here. I'd love at this time to hear some of your questions. I'm happy to stay here as long as you need me. I know Wade will stay here with me and we'll answer some questions, but I, again, want to express my gratitude for being here with us tonight. So I'm going to start taking a few questions here, Wade. I see a question that says, how much money will you keep in your bank account? I love it. Josh said, it depends on how much liquidity you need and when you need it. Let me give you a framework for this. So the answer, like good lawyers that we're not, it depends, but it should be relevant and significant for you, right, Wade? We're not lawyers, but we'd like to talk like lawyers. So let me give you a framework that I think about this. I think you need to understand this conversation based on where you are, what feels right for you, and then to create some rules around it. So in my framework, in my family, we see liquidity, we see cash in the short term and in the long term. We keep in a short-term account, in a bank account, a high yield savings account, hopefully, 30, 60, 90 days of expenses that we have on a monthly basis so we can have money to transact with. So in a personal account, we may have 30 or 60 days of our mortgage, bills, school payments, right? Anything past that is money that now I'm living in a bank, not maximizing, unfortunately, my benefits. So I move all that money into our life insurance policies in premiums so we can grow our cash values in our death benefits. Now, when it comes to this number, how much liquidity in general, in addition or regardless if it's short-term or long-term, I'll give you a good framework. And this comes from this curriculum called Tough Money. We help folks do a calculation called the burn rate. You want to know how much is it costing you to live your life in a year, in a month, in a day. And once you know how much it's costing you maybe in a month or in a day, you'll know that the number of days you want liquidity, right, is correlated to how much protection you want to feel. For some folks, it may be 30 days, 90 days. For us at Factum, we recommend 180 days of your spending, daily spending in liquid assets. It's a great starting number to have enough protection and to have enough dry powder to seek opportunity. So we will tell you, for example, if we were having this discussion, it costs you $100, okay, to live every day. Great. 180 days of that would be 180 times that $1,000 or $100, excuse me, right? The moment you start having more liquidity than that excess money, although stored in your life insurance policy, becomes money that we would encourage you to then see as money that you can deploy to create more cash flow with your investments. But the rules that I just described are not right or wrong. They need to be catered and designed and curated specifically for you and your family or your business. And we would love to give you the education that you can use to then create those rules for yourself. I hope that helped. And if you want to know more, I highly encourage you to go through these exercises, reach out to the agent that invited you, because it's going to be really helpful in getting clarity and taking ownership on what you want that number to be from a place of understanding. Hope that helps. Thank you for being here. I did see that you said $50,000. It depends. If you were worth $10 million, $50,000 would be a really low number for me. If you were worth $100,000, it may be a really high number. So it needs to be relevant and significant for you. And it says Oyate. I hope I'm pronouncing that correctly, or Oyate. So thank you again for being here for your question. Michael says it really depends. Everyone's different. The answer is we have the ways to help you clarify that. So thank you for being here. You got it right the first time. There you go. Beautiful.
And it's a framework in how we think of things. I think that's the important part, is we can help you develop a framework that works for you. It's not us telling you. It's this idea that we want to empower you to have an understanding why it makes sense and how to, where to keep it and how to keep it. We want to give you some education and some frameworks so it makes sense for you, not for us to dictate to you, this is the way it needs to be done.
Absolutely. I tell people jokingly, and I'm not really joking, I don't like being told what to do. I don't tell people what to do. So the best way I serve a community in my occupation area of life is to educate and give them confidence for them to think and know exactly what to do with the proper guidance, which is from our team. So absolutely, Wade. Michael, I see your hand raised. Yes, sir.
Yeah, I just want to share something real quick. As someone who's been doing this for a while, I experienced something I had not before, and it's the privacy part about these contracts. So my wife and I are in the process of getting a different type of mortgage for our house. It'll be in the form of a HELOC. It's a strategy that you can use, and we have a decent amount of outstanding loans on our policies. We have 10 policies, and I'm okay with that. The intention is to fix that. But that's the way it is now. And as part of this process, they can't see that the bank cannot look inside our policies and see that we have outstanding loans. So it doesn't impact our credit score or anything like that. So I just thought I'd share that. Just like it's one of the 8, the privacy piece of it is just, to me, is so important. So I just
Yeah.
wanted to share that because it's something we're dealing with right now.
Yeah. The best thing I can say to verify what you're saying there, Michael, is make sure for all of you in the call that you're looking for guidance, look for someone that has alignment with your values, with the things you're trying to accomplish, that understands, that can listen, and also that is a man or woman in the arena with you. It's one of the most important things we'll tell you. Authentic leadership is one of the values in our company. And for anyone that you see here representing Factum, you'll know that these are people that have significant amounts of ownership in life insurance. We're using this asset on a daily, monthly, annual basis, and it's a significant and relevant part of our financial life and our relationship with money. That's the kind of guidance you want. People that are having this experience day in and day out with complete belief, confidence, and conviction. For you to use that right guidance, find the right process and the right solution for the problem you're trying to solve. Thank you, Michael. Okay, I don't see any more questions, so I'm gonna give it 30 more seconds. If anybody else has one final thought or a question, we'd be happy to answer. But again, I'm gonna express my gratitude. Thank you here for being with us. I'm gonna shamelessly plug, we have monthly education, our foundation's presentation for all of you. If you think that there's a coworker, a family member, a member of your community that would benefit from being exposed to these ideas, we would welcome and appreciate that opportunity to share with them. We also have a second offering at the end of the month for our clients, and we welcome any new members of our community with more advanced and more specific concepts that go deeper into conversations. In April, we're going to talk about the mechanics of policy loans, which is a very exciting conversation. Our clients will be there, and you'll get to see how we interact with that community. And then the courses. If you want more education, I promise you, you will not have a shortage of proper education with our team. So please reach out to the agent that invited you to this call. Any other parting thoughts, Wade?
No, I just think it would be, there's a process to most things in a sequence, and it's about, awareness. Now you've been made aware. We can definitely bring your education and then taking the action, right? Empowering you to take the action
Yeah.
is going to be the real key, because without that action, then we kind of get caught in the loop of thinking about it, putting it on the shelf, thinking about it, putting it on the shelf, and then nothing ever changes. And so all I would ask you to do is think about it, get educated, find the right guide, and then take action and start making those changes in your life that you want to change.
Yeah. The last thing, ask yourself the following question just to edify what you just said there, Wade. Ask yourself two questions. Is solving this problem that I have with the use of my cash or credit, the problem that we finance everything in life, important or not important? If it is not important, you truly don't need guidance and there's not a problem to solve. So give yourself grace to not look any further into this, and it's okay. It may not be the thing that you need to go after right now. But if it is important, the second question you need to ask yourself is this urgent or not urgent? If it is not urgent, I will tell you, you need guidance and you need education for you to understand the urgency of this problem, because it's ever present. It's been happening and it's going to continue to happen daily, and it is really costly. If you end up understanding that this is important and urgent, and you're in this call and you found the right team and you have the right agent, I would implore you, please consider that the education should support your implementation, because doing something about this is the only thing that changes your trajectory with your relationship with money on a dramatic basis. And that will be the key. Taking action, learning, taking action, learning. All of us in this call can give you testimonials on how over the last several years, 10 years for me, this has transformed my life. Started with day one when I decided that there was something here that I needed to explore and take action on. So with that, I'm going to go ahead and close the call. Thank you all for being here. Have a blessed night. I hope everyone had a happy Easter, and we'll see you later this month or in May. Take care.
Thank you. Thank you.
Thanks, Wade. See you.